staying on top of the knowledge that the company is producing for that stock. And then the 17-day average covers everybody else, the day trader, the guy that 3 months ago figured out he made a bad decision, everybody who trades on that stock and is looking at the day-to-day pricing on it. I lump their average behavior into that 17-day number. Then I define how that behavior will trade against the other two types of behaviors, quarterly and annual. So in this case, we have on the S&P 500, we have a market that's been bottoming. It's had a couple bottom cycles. A lot of people are calling the bottom here at March 9th, March 8th time frame, or March 6th to March 9th time frame. And in our forecast for Pro 17, we actually called this number right here back in September and October of last year. We forecasted out that the bottom would be between 68 and 7, or 680 and 700. We did the same thing with the Dow Jones. We determined that it would be roughly 6,800 and 7,400 were the bottom 2 points Pro 17 called for that particular forecast. And it achieved it, and we've been able to make a lot of money coming off the bottom, protect a lot of assets on the downside, and also make money on the short side. Right here, these are typical behavioral convergences as described by Pro 17. When the 17-day and the 50-day moving averages are converging, that's one type of a behavioral convergence. That's when the 3-month guy and the 1-month guy come together and they've got to make a new decision. Where is the stock going? Is it most likely going to go higher? Is it going to go higher and fail? Why are these things going to happen? So for purposes of defining the behavior, I also look at positive slope and negative slope to define if that stock is in a failure mode or in a breakout mode. This looks like a negative slope right here. In most people's eyes, that's a negative long-term trend on the 200-day average. But within here, mathematically, this long-term trend has already shifted to a positive slope. Within the 200-day cycle, that's the early signs of a bottom reversal and a long-term trend reversal. It takes several weeks and several months for it to fully reverse before it becomes obvious. Mathematically, this is what allows you to pick out the bottoms. It also gives you the ability to forecast out, do I want to be in the stock for 1 month, 3 months, or the full year? So at these points of convergences, I use the terms failure to fail or failure to succeed, instead of it's going to break out or it's going to break down. It's going to or it's going to fail to. I'm looking at the ranges where it will deviate from those behaviors. When the market is overbought and oversold with terms that you guys are fully aware of, it just, for me, that means it stock's too high or too low in price compared to a particular behavioral pattern. It's not going to match what you're currently looking at today. So in the case of the S&P 500, we did call March 9th as the bottom. We called this as a failure to fail point when the 17-day rises through a positive slope on the 3-month pattern, and we forecasted out that it was going to go at least to 85 and break out to the 88 to 90 range. That's where we stand right now in our forecast for the S&P 500. If you look at these patterns in here, this is a positive slope on the 50-day average. This is the beginning of a negative slope on the short-term average. So the magic inside the Pro 17, it's going to help you define where your risk is and where your reward is based on that current market. This market right now has a neutral reading. It has equal upside and downside. It has downside to the 79 to 80 range, and it has upside to roughly 95. And the reason I can forecast that is as you learn the system and you start to understand how this system works for you, I am looking out from these bottoms and tops, 17-day cycles. This is a 17-day cycle. This is nearly the completion of a 17-day cycle, which puts you at 34 days. And we have been able to forecast systematically each one of these cycles. Those are all 17-day cycles. And this is where you're going to start making more money than you're normally going to make on a regular basis. And if you're a long-term trader, this is going to reaffirm or it's going to identify where your risk is in the long-term pattern of your stock holdings. So for everybody who lost all their money in the mutual funds or their 401ks or their individual stocks because they love that story, they love that stock more than anything else, this puts the power back in your hands where I can trade Walgreens and Home Depot and McDonald's and Coca-Cola as my portfolio, but I'm not going to sit through these market losses anymore. I'm going to buy those stocks, but I'm going to either hedge my position to the downside or I'm going to pull out and wait till it's at a price that I like. I'm not going to go chase another stock because I hear it's a hot idea. I'm going to wait till Pro 17 tells me when to buy or when to sell. If you just do that one thing, you'll no longer perform with the market. You'll far outperform the market. So for the S&P 500, we've done very well with it. People that trade the marketplace, fantastic, but it helps you define if you're holding Coca-Cola or McDonald's or one of the stocks that's in the S&P 500, you're going to get a general idea where that market's going. And if your stock is in that market, chances are it's going to follow that market, but it'll tend to outperform that market. And if there's a fault inside there, Pro 17 is going to find it and then say, don't be a part of that stock while the rest of the market's going higher because it's not participating. And it's going to give you a head start versus an after-the-fact forecast. I'll move over here to the diamonds, which is the Dow Jones. Similar pattern, similar readings. We're still in the process of, we're bottoming out. We're coming back to fair market values. We have risk to the downside, but in general, the Pro 17 analysis is basically saying that behavior is changing. The fear is leaving the market, but not completely. The part of the market that we're seeing is we're not seeing massive amounts of money coming into the market and buying this and making this market go up. It's just people from a behavioral standpoint, and that means institutions, individuals, or brokerage firms, or whoever, hedge funds, they're changing their patterns of behavior. Instead of being driven by fear or trying to short stocks down, they're starting to cover their positions. They're starting to come back into the market. If you had $10,000 or $100,000, they're not coming back in with $100,000. They're eking back into the market. That's what the general market is how it's translated through Pro 17. The next surge after we have another sell-off in the market is going to be when larger amounts of money come in because the fear is changing. The values are starting to come back to the market. And what we forecasted in our conference calls and on the analysis back in January is that we were going to bottom out in March, we were going to have a recovery, and the bull market would not be apparent until sometime between the middle of May and the end of July. And this first leg of the market right here is the first signs that a bull market is coming back but not confirmed. So we're achieving our original forecast, and it's allowing us to better prepare on how are we going to make money the rest of the year. How are we going to make money going into next year? And in my opinion, the actual bull market started right around March, the end of March. The first signs of it were around December the 8th. So that was the first shifts in behavior, which basically said shorts are not seeing as much opportunity to the downside.
I'm sorry, did you mean the end of March and the end of February?
It was the end of February, beginning of March, that transition period.
Yeah.
And the first signs that I saw through Pro 17 was the December 8th time frame. This pocket in here was the first change in behavior as a result of what happened in November, that the downside of the market was dissipating and shorts were starting to change their behavior. They were looking at locking in profits. They were recognizing that these stocks were so low that they didn't have a lot of downside left. Those were the first transitions. The secondary transition was here in the February and March time frame, where we saw panic and fear and basically a purge of everything that was bad in the market all took place, and a last-ditch effort for the shorts to make money and scare the market. So it failed. These are failure-to-fail points, and the market comes back to normal behavioral patterns. Where is the average guy trading today? So we're going to trade at premiums and discounts to these numbers and utilize a tool that's going to allow you to make no less than 10% a year, but on average, on your trades, you're going to make no less than 10% inside 17-day